welcome to RRA's quarterly conversation. I am Boots Dunlap, CEO and co-founder of RRA, the US's most trusted real estate bridge lender and private credit investor. Since 2008, we've been hyper-concentrated in transitional commercial real estate from distressed and value-add perspectives. We have a 25-person team across Phoenix and New York City and have invested over $1.8 billion in the space. Our team's greatest advantage is our steep learning curve when it comes to understanding alternative real estate product types and investing in emerging real estate trends. One of the areas we are really interested in better understanding is the US medical office market because of both the aging US demographics, but also the increased competition that legacy office being repurposed to medical office may provide. We are privileged to have as our guests three nationally recognized healthcare real estate experts. First, introducing Perry Gabuzzi, Senior Vice President of Healthcare at Kidder Matthews, based out of Phoenix, Arizona. Perry has spent over 15 years working in healthcare real estate and is a nationally recognized expert in medical office leasing, acquisition, disposition, and investment consulting. With a career that includes senior roles at Plaza Companies and Transwestern, Perry has consistently delivered transformative real estate solutions. He is also a Sun Devil, but more importantly, he went to my high school, Go Brophy Broncos. We are honored to have Perry with us today to shed light on the evolving landscape of medical office real estate. Next up, we're pleased to introduce Jay Soave, the co-chief investment officer at MedCraft, a medical office focused real estate sponsor. Jay has an exceptional expertise in identifying and sourcing healthcare real estate opportunities across the United States. He began in Chicago as a transaction attorney at prestigious law firms like Skadden Arps and Kirkland Ellis. Jay went on to serve as managing director at Tishman Speyer in New York City, one of the world's premier real estate firms. He also went on to work on the investment side and then co-founded Cadence Capital in Chicago before becoming this chief investment officer at MedCraft, the nation's oldest medical office-focused owner-developer. Jay is a double Michigan Wolverine, both medical engineering and law. Last but not least, it's my pleasure to introduce John Heitmann. John is vice president at Northmarq Chicago office, where he specializes in securing commercial real estate debt for healthcare real estate across the country. Known for his expertise in complex finance structures, particularly on healthcare real estate, John provides tailored solutions for acquisition, financing, bridge financing, construction loans, permanent debt, recapitalizations, and JV equity. Before joining Northmarq, John honed his skills at Four Pillars Capital Markets, part of Stan Johnson Company, and earlier as vice president at Cadence Capital Partners, where he worked with Jay and contributed to capital placement initiatives until it was acquired by a national brokerage firm. John has an MBA and an undergraduate degree from Boulder. Thank you, everyone. Before we get started, I'd like to invite everyone to participate in this webinar by sending questions via the chat. I'll do my best to insert as many questions as possible. And the webinar is also recorded, so you can access it later. So before we get started, I will be sharing my screen and just giving a little update as to why we found this opportunity particularly compelling. So bear with me. Okay, hopefully you can see my screen. Okay, so we all know what's happened to office since COVID, and this is a chart from CoStar. The green line is vacancy rates, and they're continuing to increase. Today, the US vacancy rate for office is approximately 14%, and it's expected to continue to go up. And all the while, there were some, particularly I'm in New York City, some legacy projects that were planned prior to COVID that are still coming out of the ground, where we still have some new office being developed. In spite of that, there's a lot of negative absorption. So we're trying to figure out what's going to be the future of office and how might office be repurposed, and also find out a little bit more about medical office. One of the things that office has been experiencing is decline in rents. There was a little bit of recovery from COVID, but we have not been able to make back some of the rental rates that we had pre-COVID. And all of that's happening in the face of a lot of inflation. So the gray bars on this chart represent the expenses that building owners might be facing as correlated to CPI in urban districts. And you can see that expenses have been increasing dramatically, but the ability to raise rents in office has not. So that brings us to medical office. And obviously, this is something that we're looking at RRA. You can see this chart just showing an explosion in population above 65. In the next couple of years, the aging population is supposed to be 2 times as large as that which it was 2 decades ago. And so this bodes very well for medical office. Additionally, healthcare workers are one of the professions that are least affected by the work from home phenomenon. And so as we look at office by vacancy, subtype, and vintage, this is a chart that charts medical office and life science, and it kind of combines them. And it's got a lot of lines here. The lines represent different vintages of office, but I tried to highlight the major one that you need to see, which is medical office. So medical office has remained fairly tight in terms of vacancy rates, and it's holding pretty nicely in the wake of what we saw earlier, escalating vacancies in general office. And I think one of the interesting things on the slide is you'll see life sciences coming out of COVID or in COVID that was projected to be a great product type. However, there's been a spike in vacancies there. And so as a result, it's kind of pulling up the other vintages of office or healthcare type office, which are going up. So anyhow, medical office, specifically not life science, is something that we find very interesting. And then also just looking at your returns. So medical office is an alternative product type or alternative product type specifically within office. And typically it's garnered a higher unlevered return because of perceived complexity behind it. You saw it spike during the GFC where cap rates went a lot higher, and there's a reason for that. There was a lot of product that was delivered in the medical office space around that time, but it has been consistently tightening. And one thing that is interesting, you can see from this chart that traditional office is starting to spike, and this was up through really the very beginning of COVID, before the COVID really had an impact on office. But you can see now, well, not on this chart, but on other charts, that the vacancy rate in medical office is a lot tighter than regular office. So this has just been a long-term trend that we've been watching. And that's spelled out a little bit more clearly here. You have the difference between medical office rent change and then traditional office rent change. And so while traditional office is continuing to lose the ability to increase rents, medical office rents have continued to increase through COVID and are expected to increase for the next 4 years. And then lastly, before I get to the panelists, as we look at different product types and compare sort of the returns on those product types, I was surprised to find out that medical office is actually the second best performing product type after industrial. Now, industrial experienced a big boom in the country with e-commerce, as well as massive cap rate compression on industrial. But even still, over the past 15 years and 10 years, it's medical office has come in number 2, actually ahead of apartments, which I think would surprise most people, and also ahead of retail and regular office as well. So all that to say, it's a very interesting product type, and we're very fortunate to be joined by these experts. So I guess I'll turn it over to Perry, John, and Jay with the first question. We're getting a lot of questions regarding shifts in demand for office. How is the shift, well, I should say, how is regular office impacting medical office?
Perry, I don't know if you want to go first. I mean, you're on the ground on the leasing side, but I think from my perspective, is there some impact? Yes. Is that more market specific? Probably. It really comes down to what you consider to be medical office. We are focused on the tenants. We like high acuity tenants. We like specialty built buildings that are built for the tenants. And those type of buildings are not ones that are typically something that they're going to leave for a traditional office building. There's a high build out cost. Usually they're putting multi-specialties into a single building, and they're going to stay there. And they're looking at these as, individual profit centers, and they're important to the mission of the healthcare systems or providers. And on the health system side is really, the stuff that you really want. Um, they're not going to move across the street to save $1, in rent, $2 in rent, and then have to build out the space and do all this stuff. So in certain markets like Virginia, outside Washington, D.C., it's very hard to build. So there's a very tight market, and you can have situations where you're going to be pulling from maybe medical office or other office buildings into that. But a lot of the stuff that we're looking at, just, you feel pretty good that they're not going to move.
I'd agree with a
Perry, how would
lot.
you? Yeah,
Yeah,
please.
I'd agree with a lot of what Jay had to say. It can work, office to medical office conversion, but I would say it works less than you would, most might think in the market. We have a pretty good case study I can share of one project that did work. Is it okay if I share my screen?
Yep, please do.
Okay. All right. So you're going to see Stapley Medical Center pop up. That's a 2-building, 180,000 square foot complex in Mesa, right off the 60 and Stapley. It worked here to convert from general office to medical for a number of factors. First and foremost, you have the ability to pull up park in front of the buildings. You've got the ability to put signage on the exterior of the buildings.
And
And
Perry, I'm not
primarily-
seeing it right now. I
Oh,
apologize.
excuse me. What are you seeing? Oh, here, let's see if let's try this again. Okay, there we go. Thank you. Now it should be working. Okay, so as you can see, you can pull up park in front of the building, and actually you can park around all sides of the building like that as well. This is the east facing exposure. And this is the first place most tenants would see and most patients would see. You can also see building exterior signage, right, over suite entries. That's also high demand. So one of the terms you've heard over the past few years is the retailization of medical office. It's important for practices to have prominent identification. Signage is a big part of that, and this building can offer that. Flexible floor plates is another thing we can offer here. And then again, great location, proximity to hospitals, and existing medical here that we were able to build off of. So we had some specialty medical, we had some primary care, and we were able to bring additional specialties and additional medical users to help complement what we had existing. And we've got additional space to keep doing that. I will stop sharing now.
How's the leasing going in that?
The leasing's been going really great. We ended the year 2023 with a very strong third and fourth quarter push. We absorbed about 67,000 square feet in the market across 4 or 5 tenant deals. And we're just looking for some more tenants this year to try to continue going. A great thing about that ownership group and that product is we can deliver substantial TI, even turnkey TI deals, which is what most of the tenants in the market today are pushing for. The tenants can show up, and if they have great credit and they're willing to commit to a long-term lease, 7 or 10 years, ownership can provide a turnkey build out, meaning tenant is going to pay rent, but they're not going to come out of pocket on those tenant improvements. That's been a big push from tenants in the market today. Most tenants do not want to write a check and contribute to the TIs. You have some cases where they will, but most do not want to do that. So ownership here has been committed long-term. They've absorbed substantial TI build-outs as part of their deal structures. Some of those TIs fall between 125 to 150 a foot, which is significant. So something else to consider when you're looking at office to medical office conversion.
And I would say, just to piggyback off of some of that, one of the challenges here, it's most medical buildings have plumbing around the exterior. Most office buildings do not. So you got to redo the plumbing. Ceiling heights, depending on what kind of uses are going to be there, might not be enough. Insulation might not be proper. Electricity might not be substantial. And then, even things like elevator. Most office building elevators cannot fit a gurney. So that might limit what practices can go on what floor, or what kind of uses you can put in the building on the higher floors without doing a cab expansion, which could be costly. So there's a lot of different hurdles that go into it. It's not quite the same as, swapping out the lobbies and carpeting and make it look pretty. There's some pretty heavy lift that has to go on under the hood to make it accommodative of medical.
I would imagine the cooling systems are an important aspect as well that are quite expensive.
Well, I mean, as I'm observing that, Perry, that looked like a very traditional, kind of Class A suburban office. And it seems to me, from my perspective, pretty scary that you just took 70,000 square feet off of the medical office, in terms of absorption for traditional medical office in a space that I would say looks very much like so many other Class A office spaces. So at least suburban office spaces. So I guess I'm kind of torn here. I don't really, I understand, Jay, what you're saying, that there's some complexity with some user types but Perry, I mean, how much configuration went into that? You talked about signage or, $150 per square foot TIs. I mean, that gets baked into the lease. So
absolutely.
It seems to me like that's, working.
It's working. Again, it's a case study, the success story we've had. My partners and I have conversations weekly with other investors who are looking at buying an office property and converting to medical office. And we say no more often than we say yes on these. This one happened to be one where we felt that the submarket and that the building, the features could work. And we've been able to prove that, which has been fantastic. As Jay mentioned, though, we did have to add some additional electrical service to the building. Plumbing, every suite we've done, we've had to add plumbing throughout. Thankfully, we've been able to do it. And while it's costly, we haven't had any issues with supply lines of sewers or things like that. So that's been great. I see some notes about the deal terms in the chat. So yes, ownership did factor in the additional TI costs with rental rate. So we've pushed the rental rate to the higher end of the market in this particular property. I mean, it's a Class A building. We've got all the features. We can offer the tenant improvements turnkey. So we are able to recapture those TIs in the lease rate, and again, through the term as well. So we're about $37 a square foot full service at this building on a start rate, 3% bumps. Some leases we're pushing to 3.5% subject to the term and the other factors of the deal. And again, if we have a credit tenant, we can commit to the turnkey TI. Sometimes we're capping those TIs at $80 a foot, $100 a foot, just depends, deal by deal, what we can negotiate.
It was that late lease rate pretty consistent with traditional medical office, or you had to offer more of a discount to get them in there?
No, we're higher than most of our competition in the market. We've been able to grow there over time as we absorb space. So we started, mid-30s and worked our way up to where we are today.
John, have you looked at any of these adaptive reuses from traditional office to medical office, and what type of financiers are in the market? Is this something that, let's say if I was an existing owner that had office and I wanted to repurpose it, is it something that would be easily financed?
I don't think anything is easily financed these days, but
Call
there's
RRA.
certainly an appetite. There's call RRA. We'd love to do a deal together. There's certainly lender appetite for these opportunities, but like the panel members have said, everything is case by case. And I think the most important thing here is location. If you're near a hospital or a major, health campus, lenders look a lot more favorably for those. We also like to see experienced medical operators like Mr. Soave and MedCraft. The lenders really do appreciate the relationships that those types of sponsors have with health systems. Just increases their chances and quickness to get a building leased up.
Jay, are you looking at any adaptive reuses, acquiring distressed office to reposition it, or you just think the lift is too heavy?
I think the answer right now, we are not. And to Perry's point, I mean, we've done it before. We redid a Kmart because that was what they wanted to do in the community. Probably should have just knocked it down because those were kind of built like garbage. But we did a Macy's reconversion, but those were with tenants in tow. I mean, when you have a tenant in tow, I mean, particularly a health system, which most of them are credit, it's a much different conversation. You're kind of, this is where they want to be. They made a decision to be there. it changes the calculus. And so, we typically do not invest in speculative development. We do all build-to-suits. Maybe we have to help lease up. We did something in Tucson where we helped health system attract physicians to their campus. And so there might be some lease up there, but going spec medical and hoping to undercut the market unless you understand some other supply restrictions, just not our game. We're looking to continue to align ourselves with tenants and uses and why they want to be in those spaces and why they're critical to them. And so buying a building and hoping that we're going to be able to find a tenant, unless we're going to get at a rock bottom price, I don't see us doing that.
Jay, would you guys look at an opportunity? Let's say you had a tenant in tow to take half or 60% of the space, and then you are leasing up the remaining 40 or 50%. Is that a strategy you guys are using? I know from the lender's perspective, that's a lot easier to get financing if that anchor tenant's got a nice brand name, good credit, and
Sure.
the revenue from that tenant probably covering your debt at a 1.0. There's very attractive financing available for that.
Yeah, and we like to cheat in some senses. So there was a very nice building that was done in Austin, Texas. We unearthed it early, ended up trading, a couple of years after we found it. And it was right by the Michael Dell Children's Hospital. Very nice building, A+ quality. But it was 150,000, 200,000 square feet, had no tenants in it. And, we were like, well, in order to get this to work, we need this to be at this price. And what we did, we have a relationship with Ascension, which is one of the big health systems there. I think Seton is the health system owned by Ascension. And said, hey, listen, what are you thinking? What are your growth plans? Where are you going to be? Because basically the developers built it, said, oh, well, we'll just build this and Seton will take it and, we'll be all happy and have a huge, presence for them. Well, they had a medical building on their campus that wasn't full. The rents that we're going to need to get this building to where it would work were very high because these practices are, they're individual profit centers. And there becomes a point where you can only raise rent so much. Google doesn't care if they pay $150 a square foot to be in the Spiral in Hudson Yards. But these groups do care that they're profitable. And so you can only push rent so much, or you're just limited in who you can go to, like orthopedic practices. These guys print money, especially with pickleball and paddle being so evasive, but it's just very selective. And where they ended up trading for, we didn't think made any sense. So we'll look at it, but it's very selective.
I've got a question for Perry. Actually, it's coming from some of the audience, but some people were asking about telemedicine and how is that impacting traditional medical office tenants?
Sure.
And I guess that'd be a follow-up too for you, John. If the financing for medical office, since you've been doing this, has become, I know the whole landscape's become more and more tough, but are lenders asking about telemedicine? Is that factoring in to projects, feasibility to get financing? So we'll start with Perry, if you can elaborate.
Sure. Yeah, of course. So I would say it's strengthened demand. If anything, it proved during the pandemic and it proves today that you need a place to go, to be seen, to be touched, to be heard, to be felt, to diagnose. And then in terms of follow-ups, which is what most docs are using the telehealth for, they're able to get the same reimbursements as if they had an in-person visit. So I don't think it slowed them down at all. It definitely hasn't stopped demand for space because it's used in addition to, it's not used in place of an exam visit.
Yeah. Jay, do you have any comments, or John? I'd love any comments.
No, I think Perry did nail it. I think COVID was a great experiment for seeing what things did. We basically we didn't see much drop off in vacancy or occupancy during that at all. I mean, we asked every time, but just really didn't happen. I think we had one doctor who asked to, give them a break for a month and then extend their lease a month. And so telemedicine, part of it is we're only targeting certain type of specialty groups. Like we want the high acuity specialty groups. So What does that mean? I get better, like we don't love like the dialysis buildings. So a dialysis building, if you go in, they've got a bunch of dialysis machines, and that's very retail-y. But if they wanted to leave, they just wheel those things out of there and they move off to the building down the street. Now you have an orthopedic group with surgery centers, the build out is much higher. And so, and that's the reason people, you break your arm, you're going to go to the orthopedic's office. You're not going to do a telehealth thing. We do, when we build buildings, we do start to accommodate for maybe little telemedicine booths kind of thing where doctors can have their privacy and talk to patients. But we're focusing on the high acuity uses where we don't see any time in the near future where those type of tenants are gonna, or those type of patients are just be like, well, I'm fine doing this from home. And I think that there was a piece of it, I'm sorry, but is that people weren't super comfortable with it. There's Walgreens bought a bunch of practices and Amazon was going to get into healthcare. And I think those have not done well. To some extent, some even closed up because people don't want to go to Walgreens and see their doctor. People don't want to go and get on the phone, and particularly as you showed earlier with the elder cohort, they're not comfortable having those conversations over a phone. So you got a couple of things here where I do think it continues to be something that is a supplement, as Perry said, but I just don't think we're there yet, and particularly for a lot of the different uses that we like.
Yeah. So just to sum that up, there's a narrative that the retailization of healthcare, that actually healthcare might be moving into retail centers. You're saying, Jay, that's not really happening, maybe with the dialysis clinics, but general practitioners and specialists, they want to be in medical office, correct? And
Yes.
so, and as you're looking at the users of medical office, if you were to just, if you wouldn't mind sharing with me how you evaluate, good tenants, like what are the users that you really like versus the type of user you don't like? And then how do you look at tenant credit? I mean, do you put a lot of weight behind hospital healthcare system? How much stronger is that than just a private medical practice that's independent?
I would say we put a lot of weight on the credit. I mean, we want, I think 60 to 70% of our portfolio is credit. A lot of these people, we like to, like I said, we like to cheat. We like to go into buildings where we have relationships with them to strengthen that relationship, grow a new relationship. Because one of the benefits of having those relationships is those deals have babies, where as they grow their ambulatory footprint, they might have a development deal. And so if you're there and actively working with them in a market, they're like, well, we want a new surgery center or something, the next town over, and you can get something from that. So credit is important. And then, it's just it's a gradient. And so health systems at the top, we like the not-for-profits above the for-profit ones. We do work with HCA, which we think is a great operator. But then, what is the difference between their credit and some of these orthopedic groups? I mean, those guys, they just print money. And we look at rent coverage ratios and things like that. So if you're looking at these top tier ortho practices, OB, ENT, with everyone getting like their colonoscopies, I mean, those things they just rip. And so you get very strong financials, in which we look at. It's not investment grade credit. I mean, these systems they got better credit than Amazon. So when you show that cap rate difference, it's like, well, why is there such a discrepancy when they got better credit?
Yeah, I mean, I guess I might have, I was wondering, sometimes healthcare systems, they might be tougher to negotiate with.
Sure.
They might be less sticky than maybe some group that's been there for a while. I don't know. I'm curious, Perry, if you were to talk about the range of medical office users from the ones that if you're someone that owns medical office, that you were saying these guys are great, this is who you want, and you can include in that behavioral health, you can include a surgery center, just all of those. Who do you want and who do you not want?
You want an ambulatory surgery center, and you want an ASC. You want that to be, I mean, multi-specialty, great. If it's orthopedics, if it's cardiology, cath lab, even better. Those seem to be very, very popular. You want you want all the specialties, right? Vein, vascular, pulmonology, ENT, as Jay mentioned. Those are all strong. OBGYN, fantastic. Dermatology are great. Dermatology doesn't necessarily feed a hospital, but they're great in the building and they're high volume. We haven't talked about any eye specialties. Those guys are high volume and they do really well as well. They're a good tenant, high demand in the market. GI groups, they like to go off campus with their endoscopy centers. They're a good tenant though to have in a building for a clinical space. If you had them on both, if you were to buy a single tenant net lease deal and it was GI with their surgery center, their ASC, be a solid investment.
What about the
Imaging-
tenants that, you might be kind of discouraging sponsors from?
Sure. I'll tell you those. You mentioned behavioral health, but I'll go back to what another favorable tenant, imaging, another good tenant there, sticky. TI investment is large up front, so they tend to stay long term. On the less favorable, we're not crazy about med spas. We've seen a huge influx of them. Behavioral, if it's IOP, that's a no here. We're not working with those types of tenants for a number of reasons. There are good behavioral health users. Psychology and those things can be fantastic, but the IOP clinics are a no.
And what about the dialysis clinic?
Dialysis would be another. They're so high traffic. They put so much strain on the building that I understand why they might be on the lower tier for Jay's tenant wish list. But they are good credit. Yeah.
Sorry, Perry.
No,
Not
guys,
just
I was
where
gonna say they
they
are.
because they wear out the building and they're like, well,
Yeah.
we'll just move over there. And then
Yeah.
Where are you?
Yeah, you're right about that. Yep.
And then can you guys touch on being on a hospital campus versus off, the pros and cons of that? And then
Sure.
also just the functionality or layout of what makes a great medical office building versus the things that as lenders we should be concerned about or investors.
Well, on-campus buildings tend to be a little tougher to lease for me as a leasing agent because we have ground lease restrictions and excluded uses. You can't bring a diagnostic imaging, you can't bring diagnostic lab, you can't bring physical therapy, you can't bring ambulatory surgery center unless those uses would be affiliated with the hospital. So that makes it a little more challenging. The other thing that makes it a challenge is the hospital has the right in most of the cases with these ground leases to say yes or no to a use. So unfortunately, we've come up against that recently on about 21,000 square feet across 3 deals, which is really a bummer because we were at execution copy of the lease, and then we get told, sorry, those uses are not going to be allowed on the campus. So that's always a challenge. So when it comes to lease up, I prefer an off-campus building for that reason alone. I just don't have to deal with those surprises because we can't bring the use ahead of time and say, do you approve it? We have to have the deal to the point where it's ready to sign before we can present it.
If it is leased, would the cap rates be tighter on an on-campus health medical office versus off-campus, or it's pretty indifferent?
I think if it's fully leased to the system, it's probably better, but John can answer that probably more specifically. John or Jay.
I think if it's fully leased to the system, I think if it's fully leased to the system, you are going to get a little bit of a cap rate premium, if you will. But kind of circling back to what everybody was saying, and Jay, some of these orthopedic groups, these surgical centers, they're doing 4 to 5x rent coverage ratio, and in some cases, you might look at that and say they're better than a health system that might have some leverage on it. I would say from a lender's perspective, specifically the banks, I think investment grade credit is the most sought after. There's probably less work for them to do in the underwriting, just knowing that it's A-rated credit. But the sophisticated regional healthcare lenders out there, they can look at an orthopedic group, surgical center doing 30 million revenue annual 4x rent coverage ratio, and I'm going to get the same 225, 230 spread that I would from an HCA, if you will. Backing all the way up to your telehealth question, that was a hot topic, I would say, coming out of COVID a few years ago. To Perry and Jay's point, I would say now it's just kind of like a little icing on the cake. You have to go to the doctor to get a true diagnosis. From my experience, we take our daughter to the allergist who has a peanut allergy, and she gets her checkups there. And if something were to really be wrong, we're going to go in. If we're just being a little paranoid rookie parents, we're going to pick up the phone, and they're probably charging me $50 for that 5-minute phone call. So not the concern that we had a few years ago, but I think that's a good good question to bring up, Boots.
John, are you raising any pref equity or JV equity on office deals right now or medical office? If
It's
so,
funny that you say
how's
that.
that being
I
structured
actually,
and what does it look like?
yeah, just over the last 2 weeks, I have had a couple of inquiries about some smaller preferred equity opportunities. And if I had to guess, it's because they're not getting the leverage from the senior debt, just because of debt service coverage ratios. Higher the interest rates, the lower your DSCR. People want to expand, so they're going to need to have, you know, new sources of capital. But that question is a little premature for me to answer right now.
Okay, well, let's get back to the functionality. So, and I'd love to hear from you, Jay, and maybe a little bit more Perry and John, if you can add. But what makes medical office highly functional versus poor functionality?
Well, I think
Hi,
here
Perry.
in Phoenix, oh, go ahead.
No, Perry, you're probably best suited for this, given
Okay, cool.
you see
Here in
everything.
Phoenix specifically, I would say, you know, 2-story footprint is ideal. Single story would probably be absolutely preferred, but 2 stories works great. Much more than that can be a bit challenging, although we do have some buildings that are 3 and 4 and 5 stories in town. Well parked, of course, we talked about that a few times. You've got to have at least 5 per thousand, preferably closer to 6 per thousand if possible today. It seems to be the demand. And, you know, if you have a few high volume clinics, you'll fill that lot pretty quickly. The functionality of the floor plate, you know, that's why I like the 2-story. Like our ideal size, I'd say, is a 2-story, 40,000 foot building, plus or minus. That's like perfect for us because even the tenants, the smaller tenants that might be towards the end of the hall, you don't have a long way to walk from the elevator core, you know, from the core of the building. Let's think, what else? As Jay mentioned, you've got to have at least 1 gurney size elevator. We're usually doing 2 elevators in a building of 2 stories. If it's larger, you'll have more, but at least one of those is gurney size. The other one is the emergency gurney services size, so it's a little smaller. And ability to have access as close to the elevator core as possible for the tenants. And then, of course, building signage, as we talked about, power, HVAC system, you know, depends on each building. It could be a chiller system. You could do package units. Depends on what's cheapest at the time if you're doing a new construction project.
And where do the tenants want to be in terms of like how far away can you be from a hospital campus, or is there any considerations in terms of geography?
Yeah, I mean, it depends on the specialty. I would say most prefer to be closer to a campus, although we're seeing a big push lately to have freeway accessibility be the #1 priority, right? How close are we to a freeway? Because the freeway arterial provides accessibility from all parts of town, and it may be in between a couple systems, which is helpful. So I think most groups, I would say, are pretty much, they're okay being off campus. We have seen a push from some groups to want to own their own real estate. Jay might be able to talk to this a bit more. He probably partners with some groups doing this. But if they identify a site or if they identify a building that they want to purpose for their use, they may pick to be between 2 buildings. They could buy it and own it without any worry about a ground lease and own it fee simple and, you know, lease it back to the practice. So there's some considerations there.
Yeah,
Jay and John,
I
I'd love
think
your
everybody
comments.
wants complementary uses kind of nearby, all in one little medical hub. I had knee surgery last year. Across the street was my physical therapist and my doctor. So I, you know, all in one little spot, not near a hospital campus, but in just like a little medical micro hub, and it's a great experience.
I would say something to touch on, it's a great question, Boots, is you know, the biggest area of growth is not new hospitals, it's going to be outpatient ambulatory centers. And the reason for that is, well, they're open only a limited number of hours, there's less infection rates, they're much easier to navigate. But one of the biggest pushes too is market share. What are the health systems, while largely not for profit, they're competitive. And so, that's why these ground lease restrictions don't let in the other systems. Like so it's not uncommon for you to see, big hospital and then competitor has an MOB across the street. And then they go into the suburbs where they're looking to get you into their system. So if you go in, so John hurt his ankle, goes sees his doctor or his primary care doctor, says, oh, my throat's really been bothering me. And they're like, oh, go talk to my ENT guy right across the street. So they're capturing you in their system, and then you refer each other all over the place. So that's why you're seeing all these ambulatory centers popping up in suburban locations to drive you to other people in the network, and then drive you for surgeries to the hospital itself. So it's all about market share capture.
Fascinating. And so you're seeing more of these micro hospitals, or is there, I mean, are hospitals getting bigger, or are they doing more small campuses? What's the evolution of that?
We don't invest in hospitals. I mean, there's new hospitals being built. A lot of them are very old. I would say that these are not hospitals. I mean, there's all these different levels within MOB. I mean, there's places where you just go to get your checkup. There might be a surgery center there. Most of the buildings do not have an overnight stay component. Some of the orthos might, because you have a surgery and they want to monitor you for 24 hours. But most of the buildings that we look to do not have beds. We just don't invest in those. And so there are micro hospitals, there are freestanding emergency rooms, there are urgent cares, there are a whole bunch of different things that have different uses. Those urgent cares and emergency freestanding EDs are about $1,000 a foot. So they're expensive. They're small and expensive. So the rent rates can be high.
Astronomical.
Yep. And then I guess technology is changing everything. Is it changing medical office? Are there any other considerations? We've talked a little bit about telemed, and it seems as though it's not changing the demand for it, but any other considerations there?
Not much has changed there, I don't think. I mean, they're still going to have a server room on site with their IT server equipment. They're still going to use some form of computer or tablet in the rooms. Maybe if anything, it's gotten smaller. Maybe they're carrying around a smaller tablet from room to room. Maybe not a laptop.
So AI is not going to disrupt the size and need for tenants in the space in terms of imaging or radiology, practices or anything like that.
I have read some articles about some advances in AI technology and reading imaging scans and their ability to detect things in a very quick manner. So that could be a disruptor at some point down the road. I just don't see it right now.
I agree.
Or it could be a good thing because they can see maybe more patients.
It's diagnosed faster, right?
I recently had pneumonia. I think I went to the urgent care at, I don't know, 5 p.m. and I got the call back at 8. So I was pretty happy with that.
I'm curious about just across the US, Jay, you seem to invest all over the country. What are the markets, and John, I know you work with sponsors all over the country. What are the markets that you like for medical office, and what are markets that you just feel like are have too much supply or too much supply under construction?
Yeah. Good question. I think we approach it a little bit differently. Well, first off the bat, love the Southeast, love the Carolinas, like Florida, Texas, like Arizona a lot. Not super big fans of California. Just pricing there is crazy. The property tax reset on existing assets is crazy. So those are the places we like, but we're tenant focused, and so it really boils down to who are the tenants, what are the uses, we like the buildings that are built for them. The good thing about healthcare, it's kind of highlighted in one of your things in one of your slides, not just the returns, but the volatility. Medical office is the least volatile asset class over a long period of time. And so you can go to markets that are not, that mainstream, main top 25, top 50 MSA and be comfortable. Put them in a portfolio and be comfortable that they're not going to get kicked out because it's not in, name your big city. We don't like, so geography is important, and so what we don't like, we don't want to go to a dying town. Like there's some towns in Illinois, we've looked at things, big, huge healthcare portfolios, and this town's dying. We're out. So tenant first, what are the building? What are the uses? and geography is part of that, but not, I'm not doing multifamily unless in these 10 markets.
Are you looking at average age of population? Is that a factor?
It is. I think it's part of the larger demographic view of, where is this town stabilized? What's driving the demographics? What companies are headquartered there? What kind of businesses are there? Is this going to be there for a long term? Using Illinois as an example, like there's some of these old towns that were manufacturing places. The manufacturing facilities have closed down. The population is declining. Not somewhere we're particularly interested in being.
Thank you. Okay, I have a bunch of questions from the audience, which I'm going to turn it over to them. So if you are listening, feel free to ask some questions. This one is about cap rates. So the best medical office, where are those cap rates trading today? And I might ask, where were they in 2022? I don't know who's the best person to answer this. You guys all probably have your view. So
yeah, I can speak to it for here in Arizona locally. Okay, then let Jay go. So here in Arizona locally, I'd say today 6 to 6.25 is probably where the top tier stuff is trading, and that was probably 5.5 to 5.75. 2021, 2022.
Is that a 15-year lease on a single tenant A-rated health system?
That's our multi-tenant medical office.
Multi-tenant.
I would say on the I remember one specifically from 2022, 5.75. It was single tenant net leased, 60,000 foot hospital system credit. So if that gives some context.
And I'd say lower than that. I mean, some of those banner deals were trading low fives, maybe high fours. So Banner is one of the best health systems in Phoenix, Arizona. So
your partner did a deal in the fours, if I recall.
What's that?
Correctly. Your partner did a deal
He might have done a Memorial Hermann deal in the fours.
In the fours, yeah.
Yeah. And so I think Perry's exactly right. I think low sixes, they might start creeping into the fives if, debt is kind of in a weird place. Fed keeps lowering rates, but they keep going up. So I would say low sixes for your thumbs up, new building, long-term lease credit stuff. And then, the gradient just as credit goes down, number of tenants goes up from there. I think you can still get good things in the high 6s, 7 cap range right now.
Okay.
And I would agree with that. We're doing a deal right now, not investment grade credit, but very strong surgical center, right around a 7 cap. But it'll be interesting to see the 5 and 7 and 10 year treasury just keep going up. So we'll see if that gets affected.
Great. I've got another question for you, Jay. You said that you do not invest in inpatient facilities. Why is that?
No, it's just not our specialty. I mean, it's not what we do. We're looking for medical office buildings. So we have looked at inpatient buildings. I'm not saying we wouldn't do it. It's just not what we do. We're not looking for places that have lodging. We don't do senior housing. We just do pure MOB.
Okay, Jay, and apparently you've got a lot of fans here. You did a deal, I think it's called the Maimonides Brooklyn deal. Do you remember that? Would you mind talking to us about how you structured that deal?
Yeah. So, I mean, it was before my time. I just asked my partner because I saw it pop up in the chat. So we were owned by Welltower. So we had a portfolio. They bought our development company. We did that as part of Welltower. It was in essence a fee for service for us, but I believe Welltower still owns it. So it was, there was a public process, which is pretty typical. We were selected as developer and funded the capital through Welltower.
Okay, and then I've got another question just about lease structures. So, medical office or regular office, multi-tenant, how much of that's full service growth versus triple net? And then is there, a push to do individual metering on suites to be able to kind of move to triple net? And maybe Jay, you can answer as well.
Yeah, I think yes on the metering, and we almost always want triple net. I think we have kind of like a informal grading scale or screening scale, shall we say? And if you see modified gross or full service gross, it's getting dinged. So we like to stay away from those.
It's definitely getting dinged, and I would imagine guys like Jay, if there's any type of value add strategy, Boots, and you're probably seeing this with the flow that you get, the sponsor's going to check to see if it's triple net market and this building,
Great
for
point,
one
John.
reason or another, is full service gross. They're going to go in there and roll those leases triple net, and they're going to create a bunch of value just by doing that.
Fair point.
Perry, any comments on that?
Yeah, I would say it's market specific. As John mentioned, we have some markets where all the comp set are triple net lease buildings, and we market ours that way. We stay that way. In the market where they're all full service or modified gross, we try to cater to that and do the same rate structures if we can. Of course, our clients, the owners, will ultimately dictate what are approved, and what our rates will be based on the market. So if we do have a triple net building in a full service market, we want to make sure we're notching ours down accordingly to be in line when we gross up to be full service. We don't want to be, we don't want to be too far apart. It can be challenging, as everybody can probably tell you. We have to have longer conversations in markets where we may be marketing a triple net building, but the rest of the market is full service, or vice versa. You just got to educate the tenants. It takes a little bit more time when you're going through the negotiations.
Because like a lot of real estate people here, we know what that means, but doctors don't.
Tenants
So
don't.
it depends on the the sophistication of the person that you're dealing with.
Mhm.
And it is a great point by both John and Perry. I mean, some markets, they're all full service growth. I mean, they just everywhere they are. And so, if you want to be there, that's what you got to grapple with.
And then another question coming in, is there a premium for cap rate on triple net versus full service growth? I mean, what do you think that premium would look like?
I think you got to price it completely differently. I don't think the cap rates correlate because, at triple net, I've got a pretty, assuming all things go well, you got a pretty predictable income stream. If I got a full service growth, I don't know, depending on jurisdiction, I'm in Chicago, God forbid you got a full service growth.
That's yeah. I think you got full service gross in Cook County. You have no idea what your tax bill is going to be. I think you're going to drive away a lot of potential buyers, which is going to increase the cap rate for that reason alone. It's very difficult to quantify. So
while we're on the topic of expenses, and maybe Jay, you guys are all triple net, but can any of you guys talk to with inflation, the environment that we're in right now, increases in operating costs or any other impact that inflation has had on medical office?
Yeah, don't forget.
We're seeing a lot on the wages.
Yeah,
Sorry,
I was going to say not just inflation. I was going to also say minimum wage increase as well. So that also impacts, your janitorial, all those costs. So
I would say
we're going the same way, John. Sorry.
I would say that there. Oh, I'm sorry, Perry. I thought you were finished.
Okay.
I would say that there's benefits to that too. One of the biggest things you touched on it earlier in your slides, Boots, was there's the ability to push rents, and I think that is directly correlated to the fact that development costs have gone up so high. So Perry's talking about what he was doing in his Mesa deal, and they're getting up to upper 30s. Well, that's where you're going to probably start if you're going to do new development. So he's got a great Class A product. I would say pre-COVID, that meant that a lot of the buildings, depending on where they are, blah, 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 you're probably low 20s is probably the market average for rents nationally, different in different markets. And then you probably could do a development in the upper 20s 5 years ago. Well, now that's upper 30s, 40s, 50s. And so the ability or the concern that you might have that the health system is going to say, I'm out of here, I'm just going to build a new one, is reduced. And so you're not going to push it to where I'm going to take my 20 rents to 38, but now I might be able to push it 5 or 10% on renewal where I couldn't before. So I think that's had a substantial impact and has an impact on where we can go with buying older assets that have lease roll coming up.
Yeah, that's a great point. Another question just around financing. John, I know banks have been redlining office left and right. A lot of people don't want to do office. How has the appetite for medical office been, and how is that evolving?
One thing we failed to mention at the beginning of this, we call it medical outpatient building now. We've stripped out office.
Rebranding. We're rebranding.
Rebranding. So medical outpatient.
Yes, I would say that the appetite from the banks has remained very consistent or increased for medical office ever since office has been redlined. You will find some smaller local banks who equate medical office and office. I've also found that the life companies equate medical office with office. It
Bucket.
gets priced a lot of the time in that bucket if you have a very large deal. I think just the exposure that they see, they're more well traveled in the medical office, if you will. But the appetite for medical office is very strong and
What about
continues today.
securitization, CMBS?
CMBS, same thing. CMBS market has been and is completely open for medical outpatient buildings. It might require a little bit of a higher debt yield in DSCR at underwriting relative to an industrial or multifamily, but you can price it pretty similar to retail, if you will, maybe a little bit higher.
And so what lender type is having the tightest financing terms in that space right now?
Yeah, so the tightest terms I've seen without, giving excess deposits, if you will, just your typical operating account, I would say is kind of 215 over SOFR, and we're typically swapping those transactions. Maybe get a few years IO, up to 65% LTV. Once again, everything is DSCR driven, so you're probably looking at a 125, something around there on a 25, maybe a 30-year AM, depending on the credit quality. I would say the meat of the bell curve is in that 230 to 245 range.
And are the sponsors wanting to fix right now or float, or what's the appetite for most of the real estate investors?
I would say the majority of sponsors are fixing it. We did go out for a 5-year deal and we elected to do a 3-year deal, however, and there's a little bit of a premium between the 3-year swap and the 5-year swap, but it is starting to come in. The problem with floating is your DSCR constrained unless you're buying it in the money cap. So to get the proceeds, you have to fix it, even though they would like the flexibility of the float. So it's a bit of a push and pull.
Okay, guys, we're down to our last 2 minutes, so I'm going to do lightning round and then close it up. Okay, so the question is, you guys have $100 million to deploy, and you get to deploy it all across the country with any type of tenant variant or functional layout configuration within the medical office healthcare space. If you could be creative, not necessarily just take the tenant with the best credit and lease the whole thing, but something that maybe might surprise the audience or be maybe an alternative type of investment. I'd love to hear your thoughts. So I don't know, maybe Jay, you're doing this now, so you might be well positioned. Although John, it seems like you've got this on the tip of your tongue.
Yeah, I mean, I think if I'm going to pick a credit orthopedic surgery center, like Perry said. I mean, those are double thumbs up. Where Perry talked about behavioral health, that might be a place where you can get yield. We're probably going to do it when we do our first behavioral deal, which we eventually will probably be one that's sponsored by a health system. I mean, there is a huge need that has been identified by the health systems. This is a problem. They need a solution for it. And so if you can get a health system that's going to do a behavioral, and you can get some market discrepancy in pricing today because of people's concerns about it, depending on the uses, so there's differences in that world. You're going to be happy in 5 or 10 years.
And the better pricing, is it in primary, secondary, geographically still Southeast?
It's everywhere. We touched on it. I don't want to talk about time, but there's not a huge that they're like New York's gonna get a premium, but you're not seeing a gigantic premium between what you can get in Phoenix and what you might be able to get in Tulsa. You just don't. It's looking at the tenants and the uses and the type of buildings and the age and all that stuff. So there's not as much of a market difference other than big market. Premium markets are more premium.
I'm going to piggyback Jay there. I'd be looking into the behavioral space as well. Maybe a joint venture with the health system, but I think there's a lot of good regional players that are growing steady and smart. And you can pick up those deals at a nice yield. And I think in 3 or 4 years, especially when mainstream financing comes into play, the REITs are already there. So I think that's a huge opportunity.
And is that that behavioral health, Jay and John, is that a standalone building, or is that, a tenant in a multi-tenant building?
I like this, probably the standalones. I think it does get a little difficult when they're commingling, but it depends on if there's multiple access points, things of that nature.
Great. Perry?
I'm going to be boring, and I'm going to say, just give me all the specialty medical, give me the cardio cath labs, give me more orthopedics, give me some multi-tenant MOB. When it comes to, imaging centers, I love all that stuff. I think you can't go wrong. I don't love behavioral as much.
What about in Phoenix versus out of Phoenix?
We're such a strong market here, and it's my backyard, so of course that'd be my preference. But yeah, yeah.
Well, that's great to hear. Any last comments, guys? I appreciate you spending so much time with me, not only during this, but beforehand in preparation. But any comments?
No, thank you for having us.
Yeah.
I really appreciated it.
Yeah, thank you very much.
Yep. Thank you, Boots. Appreciate it.
Perry, Jay, and John, thank you guys so much for joining our quarterly conversation. And to everyone listening, this will be recorded. I appreciate your time, and you guys have a wonderful evening. Thank you.
Thank you.
Thank
Thank
you.
you.
Everyone.
Thank you.